Good morning, everyone, and welcome again. We want to say thank you for having you here. Well, today we'll be speaking on another very important topic, and that is receivables. So, firstly, we want to know what is receivable. We say in a simple definition, receivable are a claim you have against your customer for maybe goods that you have sold or service that you have already provided and you are yet to receive payment. So, there are two categories of receivable. We have short-term and long-term. So the short-term receivable is what we call current receivable. It's a receivable that is collectible within the period of 1 year. Within the period of 1 year or a shorter period, that payment is due. But the ones that are done for a longer period or above 1 year, such as note receivable, they are long-term receivable. And these ones, they are not money that you will collect in a shorter period of time. So, for example, a short-term or current receivable could become a long-term receivable in the case that maybe the person default payment within a period of 1 year period, and you told them that now before we go any further, we have to put it into writing. Maybe we document whatsoever that will be agreed upon, and you have to pay maybe certain percentage of interest for the longer time that my goods have stayed with you, and you agree and put it to paper. It's no longer a short term, it becomes a long term receivable because it have gone beyond a period of 1 year. Now, the next thing we need to know is receivables are current assets. They are current assets because they can be converted to cash at any point in time. They can be converted into cash. And there are two ways you can convert receivable into cash. The first way is by your client being able to make payment, then that receivable have been converted into cash. Another way is you could sell the receivable to another person. In a larger business society, receivable can be sold. It's a whole market by itself. People can sell receivable and others can buy receivable. And when you are selling a receivable, maybe you need cash as soon as possible and you can have your customers to pay at the point in time, or maybe the payment term on the goods that was sold is longer than the time you really need to use money. You can go to the receivable market or to a receivable broker and sell your receivable. If you are selling your receivable at a discount price, it means that you are not going to get the exact amount of money you were to get from your client or from your customer. And in that case, you will also incur the loss of that portion of money that you are giving out, because you are discounting your receivable so that somebody can be able to buy as soon as possible. And when they buy that receivable, the portion of discount that you have given, whether 5% or 10%, that portion is a loss that you will incur. And you will record it as a loss on the sale of receivables in your books. So now, another thing we need to look at is, before you give goods out to a customer or a client on account, or sell goods on account, or provide services on account, there are key things you need to consider, because the reasons of selling is not to be able to sell, and at the end of the day, you cannot be able to collect your money for the goods you have sold or the service you have provided. So you try to minimize the risks or reduce the risks of people not being able to pay after they have taken your goods on account, or maybe you have provided them the service on account. So there are things you need to consider in order to minimize these risks. And the first thing you need to consider in minimizing these risks is you need to assess the customer or client ability to pay. Depending on the amount of goods they want, you need to assess their ability to pay. Know that they have the ability that they can pay that set amount of money for that goods that they want within the required time frame. These are assessments you need to do. Another thing is, you need to also understand your ability to sell on account and still operate. Because remember now, if you sell all your goods on account and at the end of the day you don't have cash for business operation, what happens? The business will suffer, because all your sales have been done in receivable, there have been no cash. to keep up the operation of the business. So remember and know like how many portion of your goods you can sell on account and still operate as a business. Understand your entity, understand the size of your business, understand your operational activity and operational needs. It helps you a lot, inform you on how to take these kind of decisions. The next thing is you should determine the percentage of goods you can sell on account to each of your customers or each of your clients. Remember, everybody don't have the same capacity. For example, goods, if you are selling like the percentage of goods you will give to a multinational company on account, you cannot give it to a small vendor on account because they don't have the capacity to even generate the money to pay in time. But multinational companies have the capacity, they do big sales and they have larger revenue coming in. So the size of the entity should help you to determine what percentage of goods you can give to that particular customer on account. If not, sometimes your money will remain with one customer or client that they will not be able to pay because the amount is so overwhelming. Building a good relationship is good, but you need to understand these things because in the end, your business has to operate as well. The next thing is you need to determine and have a clear collection mechanism, have a structure in place on how you intend to collect your cash from those goods that you sold on account. There should be a clear documented plan of how you do it, and this will help you to be able to recover your money from customers, from clients. Because if you cannot recover your money maybe over a certain period of time, obviously for financial purpose or accounting purposes, you will have to write it off. And that writing off is something you will record as uncollectible account expense. You have to record it as amount that was not collectible over the period, and that's a loss. That's something that is going against your business. So to reduce that, you have to have a clear structure, a clear plan and understanding of how you intend to collect revenue for goods that you have already sold to customers on account before you even sell the goods on account. Because have a time frame, have a schedule, have a policy, have a plan, and there should be proper documentation before selling these goods on account to these people. Even if you have a very good and strong business relationship, try to have things documented properly, because human beings, as we know, are dynamic. Things can change anytime, at any period in time. So you need to have these understandings. Now, we were talking about writing off unpaid receivables. You cannot keep having the receivables on your book, because receivable, technically, like I said before, is a current asset. So when you have them on your book, they increase the value of your entity. But if your customer refuses to pay, maybe over 2, 3, 4, 5 years, they are still there, no. For accounting purpose, you will have to write them off and recognize them as expenses against the business, because there is no possibility of recovering the money anymore. But just in case that happens, and in the long run, maybe some of these customers that you have already written off decide to pay their receivable. Now, for accounting purpose, you will still have to reinstate that person, reinstate that account and recognize the payment. You can say, because I've already written it off, so I'm collecting the money and I'm not going to record it. No. If that is found out, in the end, you are breaching accounting principles and you are breaching accounting standards. So you need to do everything possible to make sure that you stay in line with the professional standards and principles in your business. So if a customer who refuse to pay over a certain period of time that you have written or decide after a long period of time to pay, regardless of how long it has been, for accounting practices and professional practice, you will have to reinstate that customer account and be able to recognize that payment. If we are saying write off customers that refuse to pay, we are not saying you should have them somewhere separate, but don't have them on the accounting record, because literally you're not going to get that money again. It's 80 to 90% sure that you're not going to get that money again. So no need you keep it on the book to increase the value of your entity. You have to remove them, but they can be kept somewhere special. And my final word is, regardless of how long it have stayed, never stop making follow-up, because it's your entity's money, it's your business money. You need it for operation. The purpose of you selling that goods to that person or providing that service, or to be able to generate that revenue. So if they cannot pay, regardless of how long it have been, continue to check up on them, continue to make follow-up, because who knows, at some point they might just pay. And when they pay, like I said, you need to go through the process of reinstating the person's account and recognizing their payment. If you do that and you do all of these other smaller things that I've spoken about, I believe that you will try to minimize the risks of giving out sales on account and not being able to collect it, or collect a huge portion of it. Because I know in the end, regardless of how much you try, once you are making some sales on account, not every cent you will collect. Some will remain out there. But if you can practice these steps and try to understand these things, it helps reduce the amount of money that will be left in the hands of people who refuse to pay. So we want to say thank you for following us again today. Please kindly follow our page, kindly support us, kindly share to other people, kindly like and comment. Thank you very much for your support over the period that we have been operating, and we look forward to working together on a bigger platform and continue to grow together. Thank you very much.